So first, do not forget to get in on the Perseus giveaway. It's going to be pretty cool. I'm looking for everyone's playing Dune nowadays, so I can't. I'm trying to raid. You know what? I'm gonna send you all to. God, how many people
This is a
playing?
really bad. If anyone you want a pun for June, right? When
Yeah,
when they say I don't like June, it's a bit dry.
yeah.
It's still not giving me a share option at the bottom.
It said decline to be the presenter.
But I didn't decline. I accepted.
A comes before D.
Yes. A comes before D. A and D insurance is accidental death and dismemberment. Um,
Hopefully, we don't have that here.
yeah, let's hope not. That would be bad. No, because
Yeah,
I can see.
share screen down on the bottom now.
Mm-mm. Nope, I see the transcript. I can pull it up. I can pull up the Q&A. I can pull up the audio. Let me try to join this in a different way. Well, I don't know if Zoom's on. I mean, I can try to do it this way. And nobody's in the lobby yet.
No, there's six participants on.
Okay. Well, oh, that's my good one.
What do you know? It's showtime. All right.
Okay, guys. I do apologize for the technical difficulties, but I do thank you guys so much for joining us today. My name is Amber Bittner. I am actually an instructor with the Veterans Business Outreach Center that is housed within the Veterans Education Transition Resource Center in Warner Robins. I'm joined today with David Hepner. David is a procurement specialist with the Georgia Tech Apex Accelerator. But today we wanted to actually present a webinar to you guys about financing your venture, what lenders are actually specifically looking for in business plans, and some of the different ways that you can actually go about either funding your veteran-owned business or just your business in general. So we're just going to talk a lot about financing and some financing questions. With that being said, to tell you a little bit about the Georgia VBOC and everybody that is compiled in the Georgia VBOC, we are all business owners in some way, shape, and or form, and we all have a lot of different experience and expertise that we bring to the table. So we actually, our program director is Reginald Thompson. We're actually also joined by Dr. Raina Cubbage, Dr. Joe Richardson, Scott Ross, and Timothy Craig. To tell you guys just a little bit about myself, my name is Amber Bittner. I am an accredited small business consultant, certified credit counselor, and financial educator. But I have been doing business, in all honesty, in the military community my entire life. So I started my first business at 10 years old. I've had several different ventures up until last month. I was still actually sitting as the chief financial officer for a logistics company in Washington State, where we focused on government procurement by land, air, rail, and sea. Experience wise, working 2 and 3 jobs, putting myself through college in that time frame, what I amassed, I also have 15 years of large box general retail management, where I oversaw 22 different stores. And then I have 7 years in accounting and finance, to include 5 years in commercial lending with Bank of America, both at the overseas division as well as stateside. So I have a lot of experience in a lot of different areas, and I always tell everybody, please pick my brain. Okay, so pick my brain while I'm here if you have questions. But our area of coverage and what the VBOX goal is, we look for veterans, we look for military transitioning service members, their family members, then we look into ways to get them into small business, okay, to provide them with resources and business opportunities. We are a national organization, and our original coverage area was Georgia and South Carolina. However, as of May of 2023, we solely took on the state of Georgia. And so, a part of what the VBOC does, we also teach a program called Boots to Business, and the Reboot, which is hosted by Mississippi State. It's a 6 weeks course, but we host that on every single military base in the state of Georgia. So we are constantly on the road every single week teaching at every single base. But amongst every single base that we teach entrepreneurship on, we also teach at every single technical college. We teach at every single guard unit. We teach at all of the reserve units, as well as the Department of Correctional and upcoming Department of Correctional facilities. But our mission, we're managed completely by the Small Business Administration Office of Veterans Business Development. Currently, and this slide's a little bit outdated because I think as of now we have 31 VBOCs organized across the United States. But we are tasked with serving transitioning active duty service members, veterans of all eras, the Guard, Reserve, military spouses, anybody who is interested in starting or growing a small business. The Boots to Business program specifically, that is an entrepreneurial training program that is offered by the SBA on military installations. Now we have our Reboot class, which is honestly Boots to Business, but it's offered off installations. But it is a great opportunity to garner, especially if you're a transitioning service member. But you can always register for classes if you're interested by going to sba.my.site.com. Check out some of the opportunities that's out there. And at the end of the class, I will be emailing everybody a copy of my slide deck. So the hyperlinks will also be live. So feel free, like I said, you can go through any of these slides at any time and pull up any of these resources that I'm going to go over with you guys today. But with that being said, let's start talking about debt financing, right? It's the one thing that everybody loves to talk about. Let's talk about going into debt. Let's talk about how we're going to get money. And when it comes to where businesses get money, okay, a lot of businesses will solely rely on debt financing. And the reason why they rely on debt financing is because your equity financiers, when we're talking about your venture capitalists, so think about Shark Tank, okay? Everybody who sits on that panel is an angel investor. They typically are looking for the next biggest thing. So they're looking for your next big Google, your next big Apple, okay? And they typically do not fund startups like right at the starting point. So where do entrepreneurs get their money? And if they can't tap into the equity financing, there's a multitude of different ways that they get in, or that they will actually receive funds for their business, either through a debt route, through friends and family, or, you know, even going through that venture capitalist or that angel investor route. And the Kauffman Foundation, they actually explain it very, very well on where entrepreneurs get their money. And so I'm going to play this quick video for you guys, and then we're going to talk a little bit about it. Hello?
There's no audio to the video, if that's the intent.
Is there no audio? Oh, well, goodness, that would probably explain a lot. And it's okay because we can replay it. I apologize, guys, but I thank you so much for being patient with me. Let's see. There we go. I apologize for the technical difficulties. And Dave, is there a reason why it's not letting me share the sound?
Not that I know of. You've got control of the helm.
Yep, that's what I'm looking for. Because it's got a little box that says that I can share my computer sound, but then it's actually cutting that out. So one thing that I will do for you guys today, and I do apologize for that, but luckily this is the only video in this entire module. I will send this video to you guys in a follow-on email, okay? So I do apologize if there's no sound, but how the Kauffman Foundation actually breaks this down, okay? When young companies can't actually typically get bank funding, or if they don't get bank funding, they may tap into credit cards. They may tap into a lot of different sources of funding, okay? And when it comes to funding, you need some form of skin in the game, especially when we start talking about debt financing and debt lending. Because typically what a lender will like to see, and coming from a large commercial establishment doesn't typically like to touch a startup business that does not have at least 2 strong years worth of operating history. Well, how do you get funding in that respect? You have to come up with your financial plan and your financial information. And there's a lot of different types of debt financing that's out there. So you might have non-bank lending, which means you are solely relying on your cash flow, or you are solely relying on other businesses as resource partners, okay? Recurring revenue lending, where you're actually loaning money against the actual business itself. It's based solely off of the revenue that the business actually generates. You have your traditional financial institutions. And when I say traditional, we're talking about like your Chase Bank, Wells Fargo, USAA, those types of banks. Friends and family, they'll tap into friends and family. Peer-to-peer lending sources. You have Kickstarter campaigns. You have the invention of things called AngelList. Those are some types of debt financing opportunities. Be very, very careful with the next two. And the reason why I tell everybody to be very, very careful with the next two is because you may go into a commercial bank. You may go into a commercial establishment, and one of the first things that commercial establishment tells you is, hey, everything looks great, right? The business plan looks good, but you don't have 2 strong years worth of operating history. We can't help you. But then they may come up with this other option and say, hey, but you own your own house, right? And a HELOC sounds great to a lot of people. And the way that HELOCs work, this is a revolving line of credit solely based upon the equity that you own in your home. Okay. So you can get a revolving line of credit for about $100,000. You can get, whatever equity you hold in your home, that's what you can get that line of credit for. But what the banks will not always tell you up front, okay, at least verbally, it will always be written in the fine print. And I cannot stress enough, always read the fine print with any type of financing opportunity that you find yourself in. But what they won't tell you up front, say all of a sudden we know that 1 out of every 5 small businesses are successful. Okay. And those are honest, bleak statistics. But say for some reason something happens and your business goes belly up and you can no longer afford to make that HELOC payment or that home equity line of credit payment. Now who has claim to your house? It's the bank. And so you have to ask yourself those questions. Are these things that I am willing to actually put on the line for my overall business idea, okay, for my goal? But yes, you can use home equity. You can use your lines of credit in order to fund your small business. And it is a common form of debt financing for small business. Also be careful with your credit cards. And the reason why you want to be careful with your credit cards, try to pay those off every month. And you want to try to pay those off every month because that is actually how you are going to avoid your consecutive interest rates. Okay. Other things that they may tap into, they may actually look into like their 401ks. They may look into their retirement accounts. As they look into those things, also, once again, can't stress it enough, read the fine print because sometimes there are prepayment penalties. And you might show that you have $1 million in your retirement account and that looks super amazing, but you're withdrawing before the age of 65 or you're withdrawing before the age of 72, and it is a pre-tax plan, which means they're going to tax everything on the back end as soon as you withdraw it. If that happens, that $1 million can become $250,000 very, very, very quickly. So just know the nuances and know what you're getting yourselves into as you're exploring some of these opportunities. When it comes to how a lender will evaluate a loan, okay, and how they evaluate just debt financing in general, they look at something called the 5 C's of finance. Okay. And when it comes to the 5 C's of finance, one of the things that you have to be able to demonstrate to a lender, and you demonstrate this within the business plan, but your credit and your character. Okay. Do you have a history of actually paying your bills back on time? And your lenders want to know this information, because if you don't have a history of paying your bills back on time, you're more than likely not going to pay a lender back on time. And at the end of the day, the lender doesn't honestly care what the business does. And don't get me wrong, yes, they do care what you're doing. They want to make sure everything's above board. They want to make sure everything's legal that you're doing. But at the end of the day, really all they care about is that you can make a loan payment back on time with interest. Okay, because that's what they're in the business to do. And so you have to be able to demonstrate that you can repay your debts. They look at your credit score for that reason. Okay, they look at your capacity, which that's your ability to achieve your performance. Now, when it comes to capacity pieces and when it comes to specific things within your business plan, make sure that whenever you put your resumes to whomever is in your business, okay, you want to increase your capacity pieces, because this is your ability to do what you say you're going to do. So, for instance, if you were running and to give you guys an example, and it's a great example of this, we actually had a client in Seattle, okay? This client, her goal, her dream, all she ever wanted to do was open up a nightclub in the heart of Seattle, okay? She had everything there as far as her document, her capital, her collateral, cash flow, everything was there. But she had over 20 years experience as an air traffic controller, and she was trying to open up a nightclub. She had no experience in the hospitality or food industry, okay? Because of that, she was denied for her loan. She had to go out there. She actually had to get a job as a bartender. Then eventually she worked her way into management. After about a year and a half, she was able to get approved for the business loan. But as you're catering your business plan, okay, don't make some of those certain mistakes, because if you have a resume, show that you can do that job. Okay, cater your resume like you're hiring somebody for that job. Because if you say, or if you have in your plan, for example, and say maybe you're the owner of an S corp or a C corp and you have a chief financial officer. If that chief financial officer has 20 years of experience solely behind the McDonald's drive-through window, does that make logical sense for your business? And the banks look at it like that too. Okay, so it has to make sense. And if you don't have the experience for what you're trying to do you have advisors that you can fall back on? Put them in the plan, okay? Because all of that's going to build up those capacity pieces that your lenders are going to be looking for when you're trying to get approved for financing. When it comes to capital, typically they ask for about 20% of the requested financing amount. They have to see that you have some form of a skin in the game. That's not necessarily collateral. That's not necessarily a down payment. That's not necessarily money that you have to pledge up front to the bank. But for instance, if you are asking for $100,000, can you show within your business plan, that you've invested at least $20,000 of your own funds into the business? That's the typical ratio that a lender is going to look for. And I mean, think about it. If you had a sibling, a cousin, a child come up to you and say, hey, I want to start this lemonade stand. I need $100 and I'm only going to invest $1 of my own funds in this. Does it seem believable? Does it seem feasible and sustainable? Because if you're not willing to invest your own money into what you're trying to do, why should the bank invest in you? Okay, so typically they look for about 20% of your requested financing amount. Okay, and you're going to show that or demonstrate that either in your profit and loss statement, your cash flow statement, or your balance sheet, which we're going to cover just a little bit within the module. The collateral. Okay, in the event that you default on the loan, do the banks have something that they can come back and sell? That is what they're looking for. Because remember what I told you, at the end of the day, they don't care what you're doing. Yes, they want it to be above board and legal, but they want to know that you can make a loan payment back on time with interest. And if you can't make that loan payment back on time or back on time with interest, do you have something that lender can actually come back and take in the event that you default on that loan or that you can't make your loan payment? And then your cash flow. Do you have enough cash flow at the end of any type of period in order to make a loan payment, in order to do what you say you're going to do? You have to show how the cash is flowing in and out of the business for that reason. But you have to show that you have the demonstration of adequate cash in order to repay your lenders. That's typically the 5 C's. That is how your lenders are going to evaluate your business plan whenever they're reading through your business plan. And when they're looking at your credit, I get a lot of questions about credit. Now, I am a certified credit counselor, okay? When it comes to credit, lenders are going to look at both credit scores. They are going to look at your personal credit scores. They're also going to look at your business credit scores whenever you are looking into getting approved for commercial financing, okay? If you don't have a business credit score, they're solely going to rely on your personal credit score. Now, the difference between the two, okay? Personal credit scores are monitored by 3 credit bureaus. So they are monitored by your TransUnion, they're monitored by Equifax, they're monitored by Experian, okay? Scores are typically going to range anywhere from 0 to 800, with a good average being rated from 690 to about a 719, okay? Business credit scores, they're only monitored by 2 credit bureaus, and that's going to be monitored by Equifax and Dun & Bradstreet. Business credit scores only go from 0 to 100. In order to maintain a perfect business credit score, typically you have to pay things off at least 30 days in advance, okay? Keep those things in mind. Lenders do look at both scores. It's important to know, okay, if you are trying to apply for business lending, business financing, any type of business debt, ask that lender, ask whoever is giving you that debt, what credit bureaus that it reports to. The reason why you want to do this is because some banks, okay, sometimes they might advertise a product and they might actually show it as a business credit card and it has your business name on it and it looks great. And you might use it for years saying, hey, I'm building up business credit. But now here's the thing. If you ask that lender, they tell you it's going to report to TransUnion, Equifax, and Experian, which means they've actually taken out a personal card. They've labeled it or put it underneath the business name, but it's still revolving around your social security number and not the business's EIN or employer identification number. That being the case, it's only building your personal credit. It's doing absolutely nothing for your business whatsoever. Okay. Ask your lender, ask whomever you're getting that credit card through, ask whomever you're getting that debt financing through. What credit bureaus are these payments going to report to? Because if they don't report to Dun & Bradstreet, or if Dun & Bradstreet does not come out of that loan officer's mouth, okay, or that lender's mouth, it's reporting to your personal, okay, and it's doing nothing for your business. So just make sure that you know the nuances there. Make sure that it's reporting to Dun & Bradstreet. Now, unfortunately, there is no free way to get a business credit report. Okay. In order to get a business credit report, you do have to go to Dun & Bradstreet. That's www.dnb.com. Okay. In order to obtain your personal credit score or personal credit report, by federal law, you are actually allowed or allotted 1 free annual credit report through a year through your bank. Okay. So you can go into your bank at any given time, ask your banker, hey, I want my free annual credit report, and they have to give that to you by federal law. All of these, you can also find your free credit report by going to annualcreditreport.com, okay? But that's another way that you can pull a free annual credit report. But how you find out how you look to a lender, you're going to want to order that report, find out what's on it from Equifax, TransUnion, and Experian for your personal situation before you get ready for business lending. And if your credit score is low, okay, because sometimes it happens. First things first, review the report for mistakes. Mistakes happen all of the time, okay? And sometimes there are nuances out there that people are not aware of. So, for instance, medical debt is no longer supposed to be reported on a credit report. And I know right now that they're changing some laws about that. So, when it comes to that, if you have credit report, or not credit report, but if you have medical debt that's reporting on your credit report, that might be something that you can honestly dispute. What you want to do is you want to contact the creditor in writing. You want to contact them, find out how you can correct the wrong information. All credit bureaus, or all 3 credit bureaus, now accept disputes online. Okay, so you can dispute it directly. And then as you're disputing those things, talk to your lender about it. Take it into your lender, say, hey, this is honestly what happened. I had somebody else's information appear on my account and I'm getting that taken off, and show where you're actually getting that taken off. Usually your lender will be able to work with you with something like that. If the report is correct, if there are no mistakes, and say your credit score is honestly just low, the one thing to really think about are your debt to income utilization ratios. And you want to start making all of your credit payments on time, okay? Because what this is going to do, this shows your lender that you can actually make on time payments and that you're actually paying your bills back on time. You want to show that you're reducing the amount of debt that you owe, okay? Because the less debt that you have, the more money you have to make towards a loan payment. And that's kind of how a lender's going to view that. And then if necessary, guys, you can always schedule an appointment. Talk with me, okay? So I do free credit counseling. That is one of the things that I do here with the Veterans Business Outreach Center. But and you can always work with a nonprofit or a low-cost credit counselor that will actually work and kind of help you get from point A to point B, if that's something that you're looking at. When it comes to your funding request, okay, this is a common mistake that I very commonly see in business plans, but you have to write that business plan specifically for lending. And I know that this might be the wrong way to think about it, but it's the way that I've always thought about a business plan, because business plans are almost like a mathematical proof that you're going to do what you say you are, and that you can actually, your business is going to be financially feasible and sustainable, right? And that's what you're trying to prove to anybody who's reading your plan. But if you're writing a plan for a lender, you have to have your funding request in there. You have to put that either first up front in the executive summary, have it as the first page in your loan proposal. But you have to make that ask. And when you're making that ask, you have to try to answer the following questions. And you want to know specifically, how much funding do you need? That can't just be a shot in the dark. You can't say, I think I can do this venture for about $250,000. It's not going to work. Okay. How much specifically do you need? This goes into the conditions of what the 5 C's of finance are, what your lenders are going to look for. What sources of funding are you trying to acquire? Are you trying to acquire a line of credit? Are you trying to acquire debt? Are you trying to acquire equity? But what does that look like? How do you plan to use the capital that you raise? Okay, so specifically, what are these funds going to go for? Have estimates, okay? If you're buying equipment, have at least 3 pieces of that equipment that you have an estimate of, to show, hey, the highest this goes is 38,000. The cheapest I can get this for is probably like at 35, and I'm trying to price this one for 36,000. Okay? But show that to your lender, because your lender's going to need those estimates. They're going to need them for the loan officers as proof of what you're going to be using the loan funds for. But map that out. How are you specifically going to use that? Are you going to use $10,000 in working capital? Do you need $5,000 in payroll? But what does this look like? When you plan on paying back the loan? Now, one of the great things with any type of loan, if it's an SBA loan, terms are usually 1 to 25 years. So it works very similar to how a home loan will actually work. Okay. But know what the terms of your loan is going to be. Talk to a loan officer. Don't necessarily apply for a loan, but just say, hey, what are your commercial loan rates starting off at? Now, commercial loan rates, as far as your annual percentage rate right now, they're starting at about a 10 to 10.5%. But if you know that information, put it in your plan. And then, are you going to need funding for later projects down the road? Now, depending on the type of loan you get, not all banks and not all lenders are SBA lenders, okay? And not all lenders are created equal. But if you were going to get an SBA loan, and most types of commercial loan packages and commercial loan products, depending on the lending institution, depending on a lot of different things, there's usually no cap, or I'm not going to say no cap on that, but usually the cap is whatever their loan amount is. So to give you an example, the SBA 7A loan program, okay, it caps out at $5.5 million, which means if you go in or if you apply for a 7A loan, you're not going to get approved for anything more than $5.5 million. Okay, that's the maximum you could ever possibly get approved for a 7A loan. Okay. What that essentially means, say it's year 1 and you purchase a building and you take out a $500,000 loan. Well, now it's year 3 and you're looking into expanding into a different location. You still owe X amount on that first loan. you can actually take out a second loan typically, or you can take out a second SBA loan if it's approved by the lender, as long as the two totals don't cap out above the 5.5 million. So you can have multiple loans at once, typically with the SBA. If you need those types of funds for projects, start thinking about those things. Okay, start thinking about those things now, because like I said, it helps the loan officer and it helps the lender evaluate the business project as a whole. Okay. When it comes to your financial projections, typically, if you have no historical projections, how do you come up with that? How do you show that to a lender? A lender is usually going to ask for about 1 to 3 years of your financial projections, especially if you were a startup business without 2 strong years worth of operating history. Okay. Your financial projections is going to include all of the financial goals and expectations that you have. You have to base that on research. Okay. And when you start coming up with your financial projections, you know the good rule of thumb: if you market to about 1,000 people, you might be lucky if you get 100 people to come into your establishment from that. You have to be able to project, and you might talk to 800 people, and 800 people say within that first, they're going to come to your grand opening event. Okay, so you've gotten confirmation from 800 people that state they're going to come to your grand opening event. You can't bank on 800 people, okay? Because for every 1,000 people that you market to, you will be lucky to retain 100. So 800 is a high number. That's your high number. That's how many people you've spoken to. You're going to take your best case scenario. You're going to take your worst case scenario. So worst case scenario, say only 100 people show up, okay? Between 100 and 800, that's going to be how you base your projection. You're typically going to shoot for the middle, a little bit lower than the middle, because this is going to make your expectation more realistic within your cash flow. But that's typically how you're going to build your projections. And so, yes, with your financial goals and expectations, that's going to be based off of either your historical sales, the competitor research that you do, but you're going to have to come up with your month to month. Typically, a lender likes to see month over month of your sales projections for the first year. Okay, so you are going to have to come up with that for the first year. Projections are ultimately going to show and ensure that your business idea is financially feasible and sustainable, because they will break down your balance sheet, they will break down your cash flow statement, and they will also break down your profit and loss statement. Okay. And if you're asking for funding, I cannot stress this enough, because this is a very common mistake that I see. And this is actually a common reason why I have seen small businesses get denied for commercial lending, is because if you're asking for funding, okay, they won't put the funding in their actual financial projections. So when you're looking at the cash flow statement, say they're taking out a $400,000 loan in August, they never show where that $400,000 actually hits in their cash flow. Then they don't show where they're making that loan payment back September, October, November of that year. Because of this, their cash flow will go negative. And if your cash flow goes negative for any reason, typically within that first year, when a lender's looking at those financial projections, 9 times out of 10, they're not going to approve you for a business loan. It's just not going to be something that they do. When it comes to the financial statements that you need, not everybody who goes into small business is going to be an accountant, okay? But at the bare minimum, at least know how to read the 3 accounting statements. You need to know how to read your cash flow statement, you need to know how to read your balance sheet, and you need to know how to read your income or your profit and loss statement, okay? Now, don't get income and profit and loss statement confused. They are the same thing, okay? Your income statement is your profit and loss statement. Yes, those 2 terms can be used interchangeably. But financial statements that you need, like I said, your cost of goods forecast, you need your projected profit and loss, you need your projected cash flow, you are going to need a balance sheet. And then they look for about 3 to 5 years of your sales forecast, okay? When it comes to how a lender will evaluate these accounting statements through your balance sheet, okay? To give you guys an example, what your balance sheet shows, and if you're accounted minded, you already know that your assets are equal to your liabilities, which your liabilities, that's everything that your business owes, and then your equity, which is what the business owns. So ultimately what this sheet shows, it shows a snapshot of your assets, all of the claims against those assets. It's going to show what you own, what you owe, and how it's financed. And if we start looking a little bit closer at this sheet here, we can actually see that this business, whatever this business is, and we'll say that this is a balance sheet for a month, but we can see that this business has about $123,000 of cash. Okay. We can see that they have about $200,000 of marketable securities. We can see that they have an additional $100,000 in inventory. We can actually see that they've got some long-term notes. So they've got some non-liquid assets, it looks like, in the building. Yes, they're paying the depreciation. They owe about $250,000, and then their owner's or their long-term note, that's probably from the building, about $300,000. So the total assets equal the total claims against the assets when we take what is paid, what is owed, and then everything that we own. If this business was asking for $5.5 million, okay, and I was a lender and I was looking at this, it might be doable, in all honesty. And the reason why I know that this might be doable is because I know they have $123,000 of cash on hand. I know that at the end of the month, they can make a loan payment. Okay. They can make some type of a payment just with the cash that they have on hand. I also know that they may have some type of collateral pieces because they own a building for about $350,000. Now, this business might be asking for $5.5 million. I might can do this, but I need to see a little bit more information. Okay. And so when we start looking at more information, and call it peeling the onion, whatever you need to call it, but then we're going to need to see some type of an income statement or a profit and loss statement. Now, what this is going to show, this is going to show your revenue and expenses. It provides that bottom line of profitability over a specified period of time. And so now when everything's in line order, when we can see everything, we can see that this business has net sales of $1,200,000. But now when everything is said and done, when all the sales and everything else go out of the business, by the end of the month, we only have income of $18,000. This is starting not to look as good, right? And this is why your lenders need to see this information. They need to see just a little bit more, okay? As a business owner, one of the first questions that I would ask myself, in all honesty, well, why are my cost of goods so high? Because out of $1,200,000 worth of sales, they've spent $850 of that. That's what it costs them just to deliver that product, to deliver that service into their customers' hands. Why is that cost of goods so high? Then I might look at the selling, general, and admin expenses. You know, that's your payroll and et cetera. That still might be a little high for my sales and my margins, because the margins of this business are, in all honesty, they're not that great. So if this business was asking for $5.5 million, I know they have $123,000, okay, at the end of the month to make a loan payment. But on the flip side of things, the income, I might not loan them $5.5 million. Okay. This has raised some red flags. I know that there's a certain risk that's associated with this business. Still need to see a little bit more information, because how is the cash flowing in and out of the business? And so that brings us to our cash flow statement. Okay. And with the cash flow statement, this is going to show all of the sources and uses of cash. So this shows how the cash is flowing in your business. It will show how the cash is flowing out of your business. But it will break down, you know, what you're spending in your depreciation and amortization, any types of changes that you might have in property, plant, and equipment, accounts payable, accounts receivable, all of that's going to show up here. And so one thing that I can tell about this business, and say if I'm evaluating this as a lender, one thing I can tell about this business is that this business is a corporation. And I know this business is a corporation because a corporation is the only type of business entity that allows for the generation and the sale of stock. Okay. So yes, they have other financing activities that they can tap into. Still probably would not give this business $5.5 million. But now say that they wanted a 25-year term loan for maybe $1 million. That might be more feasible with what they're presenting me. But typically, that is what a lender is going to be looking at. And they look at, like I said, balance sheet, your profit and loss, and your cash flow. So if you don't know how to read those forms, Start to read those forms. Talk to your accountant, talk to your bookkeeper, just to learn how to navigate what those accounting statements are, okay? Because those are the most crucial accounting statements to your business. When it comes to what lenders need, okay, they will ask you for your basic and your personal business info. So they're going to ask you for the specific loan purpose. They want to ask you for the loan amount request. They need an exact figure, not just a shot in the dark. They want to know the type of loan that you're taking out. Is this going to be a secured loan? Is this going to be an unsecured loan? How long do you plan on actually paying this loan back? What specifically are the loan funds going to be used for? Answer all of these things to your lender. They are going to ask, more than likely, they will ask for a personal financial statement. And in that personal financial statement, you're going to have to give them or provide them an estimate of funds in your bank and your retirement accounts. And one of the reasons specifically why they ask for your retirement accounts is because when they're asking for collateral pieces of the loan, okay, and lenders don't always tell you this up front either, but say you're buying equipment or you're buying a piece of property with those loan funds. Typically, okay, and talk to your loan officer about it, absolutely, but typically you can use the equipment that you're purchasing, or you can actually use the land that you're purchasing as collateral for the loan. Sometimes you can also use certain retirement accounts. You can also use certain insurance policies specifically as collateral pieces, just depending on the lender and depending on the type of loan that it is. So yes, loan officers are going to ask you for that. They're going to ask you for the estimate of the funds. They want your monthly salary. They want any other income that you actually have, and then any type of monthly debt payments you have, your mortgage, rent, student loans, credit cards, etc. So really what forms they're going to ask for, okay? And typically whenever you're filling out a loan package, you are going to have some form of a business plan. Now, a good business plan is anywhere between 20 to 30 pages long, typically. Your business plan will honestly be catered to whomever is going to read your business plan. Very similarly to how you would cater your resume to an employer who actually might read it. You're going to cater your business plan to a lender. You might cater your business plan to an investor, a vendor, supplier, whomever might actually need to read that plan. Lenders really only need to see about 8 pages of a business plan. Okay. So it all really depends on what you're doing, but you will need some type of a business plan to present to that lender. You're also going to need some form of proof of collateral or down payment. Okay. Typically for the loan, and depending on the type of loan package that you're applying for. Financial projections, 12 to 24 months is typical. Now, I have seen some banks, they will ask you for up to 5 years, okay? If you guys need help coming up with your financial projections, that is also something that I do here at the Veterans Business Outreach Center. So I do financial planning and analysis. I also do management analysis, but we can come up with financial projections if you have good quality market research, okay? The resumes of anyone who's owning 20% or more of the business. And make sure you cater those resumes because, like I said, it goes directly into the capabilities that lenders are going to look for. But can you do the job that you say you're going to do? Cater your resumes like you're hiring somebody for that job. And maybe you don't have any, experience in the hospitality industry. Maybe you hire a manager that has 25 years experience in the hospitality industry. That increases your capacity, okay? Because you were more likely, I'm not going to say you will be, but you will more likely be approved for a business loan if you have that experience behind you versus having absolutely no experience whatsoever. And like I said, it falls into that capability piece. They look for your personal tax returns, usually about 3 years. They're going to look for any recent mortgage statements if you own your own home, personal bank statements, and then, like I said, that personal financial statement that's going to break out your actual assets. It's going to break out everything that you own, everything that you owe. And within that personal financial statement, as you're filling that out, one thing, and this will make it easier at the very, very beginning as you start to fill it out. But before you fill out that form, you are going to want to call all of your credit card companies, all of your lenders, or anyone that you might have any type of debt through, and find out what those payoff amounts are, because they will ask you the date and they will ask you the specific payoff amounts on the personal financial statement forms. So having that information beforehand can sometimes be helpful, and it can save you some time. So if you're established, say you have over 2 strong years worth of operating history and you want to go in for a loan, your lender still may ask for a business plan. Okay. But if they don't ask for a business plan, they are going to want to see a history of your business financials. So yes, they're going to look for 1 to 3 years, and then they're probably going to go 2 years prior, which means 2 years before what you've actually operated. They're going to look at your operating agreement. They want to look for any licenses that you have, any HOA considerations that you have. They're going to ask for those sorts of things. They need to see the actual proof of collateral that you have. They want to see down payment, typically about 15 to 20% of what your loan ask is what they're looking for the down payment. Once again, resumes owning anyone owning over 20% of the business, they want to see that. And then they're also going to ask for that personal financial statement. If typically, if you have over over the 2 years of operating history. But the lending process, in all honesty, from start to finish, it works very similarly to how a home loan works almost. Because the first and foremost, you're going to sit down with your loan officer, or not your loan officer, but you're going to sit down with your lender and the borrower. You're going to determine, you and that lender, you're going to determine how much money you need. So the use of loan funds, what you're actually going to be using those loan funds for, and you're going to map that out to the lender. And then you're gonna fill out the loan application. Okay, now that can be done online. Some banks will have paper applications. Some will actually have an app that you have to go through. It honestly just depends on the lending institution, what technology they're using. But after you apply for the loan, you're going to provide all the specific documentation that they ask for. Like I said, those personal financial statements, your tax returns, your bank statements. Start collecting those things. And if you think that you're going to apply for lending, start collecting those things now so you can have them in hand if a loan officer asks you for them. The lender, at that point, they're going to discuss what your needs are. They're going to help determine loan solutions. And they may have different loan solutions for you. So you may actually talk with that loan officer or that lender and determine you don't need as much money as you thought that you needed. You can actually do this with maybe a $50,000 line of credit and an additional $25,000 loan. They're going to cover those things with you right there when you talk to them. After that, then they're going to take your application and paperwork. They're going to go ahead and they're going to review all the documentation. And after they review all of that documentation, they're going to pass that loan package to your underwriters. Okay. Now, how your underwriters are going to view things very similarly to how we just reviewed all of the financial statements, but they're going to put some of your numbers into a couple of different ratios. But the underwriter and the credit manager, they're going to review your loan package to determine your approval status or your counteroffer. Okay. So at that point, one of three things are going to happen. If the terms are met, the loan's going to go through the document process. Everything's going to be closed. The funds will be direct deposited into your account, usually within a couple of days. Say it's not approved. They come back with a counteroffer, which means you might be asking for $500,000. They can only approve you for about maybe $2 million. They're going to call you with that counteroffer and go over those terms with you, or they're going to give you a denial. Okay. But once the loan documents are sent back to the client and the loan officer, if the terms are met, that's when you're going to get your documents back. Once you get those documents back, you're going to meet back up with the loan officer. That's when you're going to sign everything. Okay. Signed documents are going to be reviewed for completion. And then your loan funds, like I said, are dispersed directly into your account, usually through ACH, honestly, just depending on the lending establishment and how you prefer to get paid. But before you want to apply, what you essentially want to repair, start having your books in order. Okay. Start talking to your bookkeepers and everything now to make sure that your books are in order. Understand your financial statements and position. So understand how your cash flow looks, understand how that profit and loss statement looks, understand how your balance sheet looks. Okay. Have a strategy, have clear goals, have that specified within your business plan. The other thing that I do for all of my clients, I do read and review business plans. And when I read and review business plans, I read and review them wearing 3 hats. So I look at them like a lender, I look at them like a business owner, and I look at them like a manager. So you get objective feedback from me. But if you want my feedback, feel free, send those things to me in an email. I'll be more than happy to meet up with you. But you want to have that strategy and those clear goals in that business plan. You have to put numbers to those goals. You have to know exactly how much outside funding you need. You want to know exactly what the money is for, because a loan officer is going to ask you that, and they're going to ask you to be specific. And if you just wanted $10,000 to hold into your account just as a safety net, you're going to have to explain that to a loan officer or a lender, and they may or may not like those sorts of answers. So what specifically are you using the money for? What you want to research, think about what your time frame is to actually to pay back the loan. Okay. Think about the types of loans and the types of lenders that are out there, because not all lenders are SBA lenders and not all lenders are created equal. But you can always find lenders by going to, sba.gov/lendermatch. That's a great resource to utilize. Look at community development financial institutions and credit unions as well, because typically, say you can't, get that commercial loan because you've applied and you don't have that 2 strong years worth of operating history. Usually your credit requirements are not as stringent with credit unions. And one of the reasons for that, because where a large commercial establishment might approve a commercial loan, say a credit score of 680 and above, credit unions might actually come in at about 670 and above. One of the reasons why they can do that is because they have those member fees. Okay, they have something to fall back on. And then you have your community development financial institutions, which are micro lenders. They are completely solely nonprofit in the business of economic development. They have even less strict credit requirements. Okay, so know what types of loans and types of lenders are out there. You can